Welcome to the second presentation in this chapter, titled Sustainable Exchange Traded Funds. This presentation is linked with the first presentations on indices, as ETFs are based on them. Exchange traded funds became, over the last 20 years, one of the most important investment instruments used by institutional as well as retail investors. This leads to the question if and how this instrument can be used for sustainable investing. The table of contents of this presentation shows us the following sections. We first start with exchange traded funds and the market's growth rates. Then we will pass to investors' main selection criteria for investing in ETFs. This is followed by implementing sustainable investment strategies with ETFs. Afterwards, we ask, hey, how sustainable are sustainable ETFs? And some of you will be irritated as they assume we would repeat a section from the last presentation. But this is not the case. In the last presentation, that question was on indices, and now it is on ETFs. This is followed by a literature review and a reference list. Exchange traded funds, the abbreviation is ETF, are a specific type of investment funds. ETFs form baskets of securities that are traded on an exchange just like a stock does. ETFs are based on an index which they try to replicate. ETF share prices fluctuate all day as the securities represented in that index also fluctuate as the ETF is bought and sold on the market. This is different from traditional mutual funds, which only trade once a day after the bond and stock markets closed. ETFs may contain different types of investment instruments. As an example, stocks, bonds, commodities. Some offer holdings of only one country or only one sector. Others are international. Replicating an index leads to advantages for investors as they profit from professional portfolio management and diversification. Even with low investments, investors receive a broadly diversified portfolio at relatively low costs. We proceed with the introduction to exchange traded funds. Cost characteristics of traditional actively managed open-end funds generally ask for, first, an upfront fee of up to 5% when buying, and perhaps additionally up to 5% when selling the fund. Second, an expense ratio of active funds between 2 up to probably 5% per annum, plus a performance fee of up to 20% for the investment manager of the fund. In contrast to that, ETFs can be bought and sold on an exchange for costs like a stock transaction, which is about, depends on your broker, 0.25% on average. As they replicate an existing index, ETFs avoid specific types of costs, as an example, transaction costs of an active management style, as well as the fixed compensation and the performance fee for an investment manager. For this reason, ETFs are a very interesting instrument for institutional investors as well as for retail investors. This explains the growth rates of ETFs over the last 30 years. ETFs could be based on sustainable indices and are then called sustainable ETFs. In case ETF investments would represent a high sustainability level, the use of this attractive and very desirable market could boost sustainable investments significantly. We now present growth rates of ETFs and sustainable ETFs. Although the first ETF was issued in Canada, the success story of ETF started with the first issue in the US by State Street Global Advisors in 1993 with a product on the S&P 500. At the beginning, ETFs have been intended to offer individual investors access to passive, indexed investments at a low price. In the US, ETFs perceived a continuous growth in the following years and profited substantially from an increasing demand for passive investments. Nowadays, passive investing represents the leading investment strategy. ETFs are used by all types of investors. In Europe, the first listing was effectuated in 2000. In Europe, the first listing was effectuated in 2000, when Merrill Lynch International issued 2 ETFs on the Deutsche Börse. The same year, Switzerland, Sweden, and UK also started the trading of ETFs. The following 3 graphs show the amazing growth rates worldwide, in Europe, and for sustainable ETFs. This graph shows the development of assets of global ETFs in billion US dollars from 2003 to 2021. The graph on this slide shows the development of the European ETF industry's assets under management between 2000 to 2022 in billion US dollars. Compare the volume of 2003 with the volume in the US on the last page. Then you understand that the US market was already strong developed when the European market started. With this slide, we come to sustainable ETFs. This shows the growth of the assets under management for sustainable ETFs by region from 2000 to 2020. Although the US market forms the biggest ETF market worldwide, it can be seen that the European market is the strongest for sustainable ETFs. Well, according to the table of contents, we now approach the next section titled Investors' Main Selection Criteria for Investing in ETFs. We go to the next slide. Altogether, we have listed 10 ETF selection criteria for this slide and 5 on the following. The first one is the benchmark index of the ETF. The index has to be selected according to the investor's personal situation, being rich or less rich, more or less risk averse, the reached diversification degree of your current wealth. All that has an influence on the decision. The second criteria is the fund volume and currency. The higher the fund volume, the lower the costs per unit. Foreign currency leads to exchange rate risks, which is often not avoidable. But return payments in foreign currency imply transaction costs for currency exchange. The third point is the total expense ratio, composed by transaction, marketing, and administration costs. For the same benchmark index, the lower the better, but also check return and risk over the last years. Fourth, return and risk. Compare with ETFs of the same index. The higher the return over the last years, the better. The lower the risk, the better. And fifth, the type of index replication. This could be synthetic, based on swap agreements, versus optimized replication, also called sampled, versus entire physical replication. Swap agreements cause an additional counterparty risk. At the same time, the operational costs should be lower because of missing transaction and custodian fees. For the next 5 selection criteria, please move to the next slide. Point 6 is the use of returns. They could be physically paid out or automatically reinvested. Return payments in a foreign exchange could cause additional transaction costs. The investor has to check what his preferences are. Point 7 is the age of an ETF. The longer an ETF is already existing, the more data about return, risk, and tracking quality do exist. This is an important information for decision making in case of alternative ETFs. Criteria 8 is on tracking quality, referring to the index. This measures the deviation between the price development of the index and the ETF. Expected is a very low deviation. The next point is the eligibility for savings plans. This is important for retail investors who want to invest monthly in an ETF. If eligible or not depends in most cases on the investor's broker or bank. And the last point, securities lending. Does the investment company offer securities lending to enable external investors to engage in short positions? Securities lending leads to additional fund income and affects positively the ETF's net asset value. According to the table of contents, we now approach the next section titled Implementing Sustainable Investment Strategies with ETFs. In this section, we try to understand how sustainable investment strategies can be implemented. First, it's important to say that investment companies may implement sustainable investment strategies with ETFs only if sustainable benchmark indices exist. The discussion in the first part of this chapter on sustainable indices showed that sustainable indices do exist. So keep in mind the availability of sustainable indices is a bottleneck factor. ETFs depend predominantly on indices with exchange-traded security bundles. As long as exchange-traded companies are only cautiously changing their old business model to a sustainable business model, such companies will perhaps show an acceptable ESG ratio. But an investment in those companies will not offer a high level of sustainability or any significant impact. We will now approach the question, how sustainable are sustainable ETFs? Probably you remember that we had a similar question in the last presentation. The last time we asked for indices, now for ETFs. This time we work with a real case with data from an ETF platform. The following slides summarize results of an unpublished thesis project by Kerber in 2022. For the search process, the platform Just ETF has been used, one of the leading ETF platforms for investors. On this platform, sustainable ETFs tradable in Europe, investing in the asset class stocks with strategy long only, have been searched. On March 28 in 2022, 75 sustainable ETFs have been identified with this search. They are based on 63 different indices. All indices claimed to be sustainable. Issuers of these ETFs are Xtrackers, BNP Paribas, UBS, Lyxor, Amundi, and others. All ETFs have names like ESG, Sustainable, SRI, which means Socially Responsible Investments, Socially Responsible, Climate Change, Paris Aligned, Low Carbon, and so on. In the next step, all 63 benchmark indices have been analyzed by checking which of the 7 sustainable investment strategies have been used. This slide shows the next step in the approach. Sustainable indices will be developed based on sustainable investment strategies. In a first step, those investment strategies have been assigned to expected sustainability levels. As you see, negative and best in class represent only a weak level of sustainability. On the other hand, impact investing, themed investing, as well as the EU Paris Aligned benchmark and the EU Climate Transition benchmark represent a strong level of sustainability. In the next step, each sustainable index has been assigned to a sustainability level based on the sustainable investment strategies needed for the construction of this sustainable index. This slide shows how often the sustainable investment strategies have been used in the construction of the 63 indices. In general, an index combines more than one investment strategies, of course. We learn that negative screening, ESG integration, and norms-based screening have been used very often. And on the other hand, engagement and shareholder activism and also themed investing has never been used for the indices. On this slide now, we see how the 63 indices have been assigned to different sustainability levels. 31.8% are evaluated to be lower than moderate, and only 30.1% of the indices have been evaluated very strong sustainable. On this slide we show the final results. Based on sustainability levels of the indices, the ETF sustainability can be determined, and the number of ETFs with the best accessible sustainability level has been identified with 25 from 75. On the table to the right, we see that the sustainability level strong for the ETFs could be offered to 33.3% of the ETFs, which means 25 of 75 have been listed as strong sustainable. 34.7% of the ETFs are evaluated with moderate sustainable. The remaining are either weak or moderate weak. From 75 sustainable ETFs, 18 are compliant with Article 8 SFDR, which means Sustainable Finance Disclosure. Okay, I do that another time. The remaining are either weak or moderate or weak. From 75 sustainable ETFs, 18 are compliant with Article 8 SFDR, which means Sustainable Finance Disclosure Regulation, and 13 are compliant with Article 9 SFDR. In the case mentioned, strong sustainable ETFs represent 41.1% of the assets under management, although they only represent 33% of the ETFs. It seems that a strong ETF possesses assets under management above average. Now we come to the results of that real case study. Based on the sustainability definition of the reported project, sustainable named ETFs reach very different levels of sustainability. This suggests that regulators worldwide need to sharpen their understanding of sustainability in order to grant trust to investors necessary for future market development and to avoid greenwashing. According to this project, Article 8 SFDR ETFs are with a high probability not among strong sustainable ETFs. Article 9 SFDR ETFs are with a very high probability among strong sustainable ETFs. For all 75 sustainable ETFs, operating costs are between 0.1 and 0.41%. For the strong sustainable ETFs, this lies between 0.12% and 0.3%. It seems that strong sustainable ETFs are not more expensive than the less sustainable ones. European investors have opportunities to invest strong sustainable, given that they search for the information necessary and for the data. Although strong sustainable ETFs still form a minority within the group of ETFs pretending to be sustainable. As we can see, greenwashing is omnipresent and investors need to be informed. In the literature review, we have two papers. One is from Ielasi and Rossellini in 2019, titled Responsible or Thematic: The Two Nature of Sustainability Themed Mutual Funds. The second paper is from Miralles-Quiros et al. From 2019, titled Diversification Benefits of Using Exchange-Traded Funds in Compliance to the Sustainable Development Goals. We move to the next slide for the review of the first paper. The literature review is structured into research question, methodology, and findings. We start with the research question of the paper of Ielasi and Rossolini. The authors try to research whether sustainability-themed funds are able to generate benefits for investors in terms of risk-adjusted returns compared to other responsible funds, as well as other thematic funds focused on themes other than sustainable economy. This should verify if the thematic style has an implication on risk-adjusted return, or if the sustainable thematic topic is responsible for it. Regarding the methodology, the authors use a data sample of around 1,000 open-end mutual funds. In particular, the sample is made up of 302 sustainable thematic funds, 358 other sustainable funds, and 341 non-sustainable thematic funds. The period of investigation is from end of August 2007 to end of July 2017. The study applies the capital asset pricing model methodology, as well as the Farmer and French 3-factor model and the Farmer and French 5-factor model. We come to the findings of this paper. The results are twofold. First, the study documents no statistically significant differences in terms of performance between sustainability-themed funds and other sustainable funds. This means the sustainability-themed approach can be applied as the investor's main portfolio strategy or combined with other responsible screening methodologies without changing the overall risk-adjusted performance. Second, the findings show that sustainable themed funds are characterized by lower risk-adjusted performance than non-sustainable themed funds. On the other hand, sustainable themed funds are able to overcome the market turbulence better than other funds. We now discuss the paper of Miralles-Quiros et al. From 2019. Regarding the research question, the authors analyzed the benefits of adding SDGs, exchange-traded funds, to a stock bond portfolio and evaluate the out-of-sample performance of 4 strategies using the returns and volatility forecast from a rolling sample approach. Regarding methodology, investors' wealth is given by a stock bond portfolio plus the possibility to invest into SDG activities. Data has been collected from June 25, 2008 until March 29, 2018. Daily returns of 6 ETFs investing in companies focusing SDG principles. The authors analyzed the out-of-sample performance of applying the spanning procedure to 4 investment strategies. These are minimum variance, mean variance, capital allocation line, and risk parity. Regarding the findings, the results confirm that it is possible for investors to receive positive contributions in case of buying ETFs which invest in companies focused on SDG investing. This is especially the case for those SDG ETFs focused on decent work and economic growth, which is SDG Goal 8, and industry, innovation and infrastructure, which is SDG Goal 9. The authors show that this leads to clear improvements in portfolio performance and cumulative returns compared with the initial stock bond portfolio. These findings are relevant not only for academics, but also for active professional managers. Well, according to our table of contents, we now approach the reference list. And the reference list is shown here. There is an interesting paper, Clemens, from 2022. Ielasi Rossolini was the paper in our literature review. Kerber, the paper or the thesis which we used for our real case. And then you see the last paper, Mirales Quiros, 2019, which was mentioned in the literature review. Yeah, ladies and gentlemen, we are at the end of this presentation on sustainable ETFs. I hope I was able to explain you the importance of this topic. The appropriate use of ETFs in sustainable investing is a fundamental step for the speed of transformation into a sustainable society. In the meantime, ETFs captured a high market share of the wealth management market and are used by both institutional and private investors. In this chapter, you learned for an ETF investment how to ensure the highest possible sustainability level. The intention of this chapter was that you learn how to use this important financial instrument to execute truly sustainable financial investments wisely. Use your new knowledge and help to invest capital in the best possible way for our and future generations, so that we all will have a safe and satisfying living and working environment. Thank you very much for your interest and patience, and take care.